My name's Nicholas Byrd. This is my Bloomberg Industry Project for Dr. Cressan's 451 class on investment analysis. The two industries I did were oil and semiconductors. So I did the class oil industry, and then I chose semiconductors because I hear a lot about them on the news, and I have over the years, and I never really knew what these companies did or why I was hearing about them so much, so I wanted to learn a little bit about them. So for both industries, what we're going to look at is ROE decompositions to mainly focus on their profitability and asset efficiency. We're going to look at the capital structure, interest coverage ratio, market and enterprise multiples, economic value added, liquidity, supply chain analysis, and analyst recommendations and target prices. So it's a lot to cover for 10 companies, so we're mainly going to focus on either trends that we're seeing, outperformances, or laggards, and not really focus on every line for every company, but mainly hit the main points. So just looking at oil versus semiconductors, we're seeing semiconductors outperform in the later half of this year, as during the summer they crossed the Dow Jones Oil Total Stock Market Index, and these are just based off indexes, not the 5 companies for each industry. The SOX index is the semiconductor index, which is pretty popular. And what was interesting is that part of that SOX index, which has performed pretty well this year, 4 of the 5 top performing companies are part of my industry that I was analyzing. So I did Broadcom, Qualcomm, Texas Instruments, and Intel. And as you can see, they performed very well. Not as good as Nvidia, and it would have been interesting to do them as well, but they weren't performing quite as well when I picked my companies. So for semis, one thing about semiconductors is that their prominent use in the tech space makes them a good tool to evaluate the technology sector as a whole, and that's one of the main reasons that you do hear about them on the news, is that you can infer their performance onto the whole technology sector as a whole. Lately we've been seeing a lot of industry consolidation. We've seen growth in sales slow down in 2015 but pick up slightly in 2016. Potential risk would be Trump being elected, because a lot of these companies have revenue exposure to China, and there's really a lot of uncertainty on Trump's tax policies on revenues from China and goods made in China. So the major drivers of growth that we've seen up until now has been in the PC market, mainly high performance computers. That's the supercomputers we hear about with like high frequency trading, but really they're used in a lot of different industries. Medical and wireless infrastructure, so that's cell phones and stuff like that, and growth in iPhones and Samsungs has really helped out semiconductors a lot, because their chips are what drive all of that. And like when you hear about how Apple iPhone is made, it's really just put together by them, but the internal is a bunch of different companies' chips and other stuff. But what we're going to see going forward as emerging drivers is going to be the new technology you're hearing about: 4K HD TVs, wearables, smart home, drones. Virtual reality is a big one, and 3D printing. So just to look at the semiconductors return on equity. From this graph, you can see there's one laggard, and it's Micron, purple graph, and their return on equity has actually dipped negative. And then there's one outperformer that is Avago, and we'll just either call them Avago or Broadcom. They go by the Broadcom brand name, but they're still used in Avago's management. And then another thing I see is that Texas Instruments has performed pretty well. They don't have an extreme increase like Broadcom, but since 2014 they've pretty much steadily increased their return on equity. So we can look at what's driving that. For Micron, the laggard, it's pretty clear that it's their interest burden. And what happened with Micron was they increased their debt an extreme amount, and they've really been getting criticized about it publicly. And it makes their interest burden negative, as their EBIT is a negative number now, and their earnings before taxes is positive. So that's why they have a negative interest burden and a negative ROE. For Avago or Broadcom, you can see that it's in their operating margin, and it's the same with Texas Instruments. But really, for Avago, their operating margin more than doubles in 2016, and they're really reaping the benefits of their merger. Now, I can't say it's just their operating margin, and that just plays a big role, but every one of their ratios or margins has increased from 2014 to 2015 to 16. So that's why you can see their ROE increasing so much at a rapid pace. And then Texas Instruments, it's pretty clear. It's just steady growth from 2014 to 16, and that's why they're going to see, other than their tax burden, that's one thing that is going down. But other than that, it's mainly their operating margin and their asset turnover just steadily increasing. So, why is Avago increasing so much? It's the merger that they did with Broadcom. Their current enterprise value is $83 billion, when it was expected to be around $77 at this point. One thing Avago did have to do was issue a large amount of debt to finance the $17 billion cash portion. So, speaking of debt, let's look at their debt ratios. And as you can see, you have Avago's way up there, more than at past 50% in 2015. And it's come down a little bit, but nevertheless, they increased their debt from zero all the way up there. You also see Qualcomm had zero debt at one point, but they've also gone up past 20%. And the only one who's really decreased their debt over time is Texas Instruments. And then, like I said earlier, Micron is another company that has issued a lot of debt. But analysts are more, okay with Avago's debt because it financed that merger, and as you can see, it's coming down now, whereas Micron's is going up towards Avago's level, and they don't have as many profitable projects, or they aren't in as many lines of businesses with high margins like Avago is. And then to look if they can afford their debt, we can see as for the interest coverage ratio, we can see that Avago and Micron might be in a little trouble. I wouldn't put that on Avago. I think they will be fine even with a negative ratio. Micron is not so much, but Texas Instruments, you can clearly see, has the best interest coverage ratio and the most you could say healthy company when it comes to this ratio. As for liquidity, most of them are pretty liquid. The one company that isn't, that doesn't look great, it would be Micron relative to the other companies. You can see they're much lower. And then the most liquid company or the two most liquid companies are Avago and Qualcomm, and that's really why I say that Avago's interest coverage ratio isn't that as much to worry about, even though it was the lowest. You can see they're clearly liquid with a 3.37 current ratio, and that's really it for their liquidity. They really don't have too much problem going on there, except for maybe Micron. Now, to look at their enterprise value to EBITDA multiple, the enterprise multiple, you can see Avago's has skyrocketed compared to everyone else's, and that's because of that merger, where you can see in their table that their enterprise value goes from 34 billion to 83 billion in a matter of 1 year, which is pretty remarkable. And another thing is just looking at enterprise values. You can see another one that looks good is Texas Instruments. And really what I came to the conclusion, I'll go ahead and say that these were my main 2 picks for this industry, and you'll see going forward as to why. Because pretty much in everything I've done and everything I'm going to do, that they're the leaders in most of these metrics. One thing you can tell by Micron is theirs is declining over the time, and they're pretty much the only one doing that. So I really don't like them with these measures either. Now we can see what kind of multiples these companies are trading at. One thing about Broadcom or Vago is that they're trading at an extremely high multiple right now. As you can see, 96.2 for current, and that means these investors are paying a lot for their growth prospects, which means they may be a little overpriced right now, and maybe might be better to wait for it to come down. As you can see in 17 and 18 there, PE ratios come down a little bit, so they might have a little room to come down. I still like them as a company going forward though. And then you can look at Texas Instruments price to book ratio. That's one thing I like about them, is that they have a high price to book ratio versus other people, and it's pretty much steadily growing. So that's another reason why I like Texas Instruments. Now to look at their EVA spreads, one thing that sticks out to me here is Texas Instruments. They have the highest with 13, when most of them are barely in the positive territory. You can see Avega is negative 7.3, and Micron at negative 8.9. Qualcomm looks decent with this metric with a 2.9 EVA spread. But what I get from this is Texas Instruments has really their EVA spread went down a lot in 2016, but has rebounded, and it looks like it will continue to grow. And there's really an uptrend. There's an upside trend in all of the companies in the last few months. As you can see, they're all going up at the end of their graphs. And supply chain analysis. This is pretty important for these companies because a lot of them have major deals on the revenue side with companies like Apple or Dell or these Samsung, big technology companies that sell computers or cell phones, that a chunk of these companies' revenues come from. So, but to look at suppliers first, the one thing that sticks out is Qualcomm's has one supplier supplying 44% of their cost of goods sold. It's crazy high number. And Taiwan Semiconductors is a huge semiconductor company, and you can see they're actually the number 1 supplier for Avago and Texas Instruments. But I don't think it's a bad thing. I think the 44% may be a little high, or maybe they're a little too dependent on this company. And then in general, what I'm seeing is just high numbers for dependency on both sides, revenue and cost of goods sold side. For as far as customers go, what we can see is how much these companies depend on Apple. You have Micron at 8%, Broadcom at 13%, and Texas Instruments at 11%. So Apple's supplying a lot of these companies' revenues, or they're responsible for a lot of these companies' revenues. And then Qualcomm is the company that goes with Samsung. over Apple, and they're at 10%. So that's a supply chain analysis of the semiconductors. And analyst recommendations. What I took from this was that there was a lot of buy recommendations, fours and fives. The recommendation, they're from different companies, so they're different terminologies, but they're all equivalent to 4 and 5 if they're buys or outperforms. And the BARR, the reason what I did here was I ordered all of my recommendations based off the Bloomberg return rating, and so this bases all of their it ranks all the analysts based on their returns that would stem from their recommendations. So I felt like the people who had the highest returns were probably going to be giving me the best recommendations going forward. And so to look at their target prices, Avago in particular, they're having very high target prices relative to their current value of 164. And same thing with kind of all of the companies, except Micron. They are not seeing high target prices as a percentage of their current price. For Intel, you're still seeing that, and then same thing with Texas Instruments. Man, Texas Instruments is seeing much higher target prices. So my two picks are Avago or Broadcom and Texas Instruments. They both performed very well over the last year or so, and I see them going higher from here. And I think right now would be in particular a good buy time. As I showed earlier, the semiconductors had a minor sell-off in November, and just looking at their relative strength index, they're about to cross back over that 60 level, and the rule of thumb is that when this crosses, you'll see a rally. So I think maybe now would be a good time, as prices should appreciate, and that's just short-term thinking, but I like them long-term as well, and based off those analysts' target prices, I think that's pretty consistent with my view. So for oil firms, I did Chevron, Exxon, Marathon, Valero, and Conoco. Their return on equity is a little bit different than the semis, where you can see you can see declining ROEs as the trend, except for Valero. They're the one company that has increased theirs. But we can look at what's driving their ROEs. For Valero, why have they outperformed with their ROE? And it's in their operating margin, which is almost doubled. You can see that's really the only, everything else is going down except for their tax burden, and that's so operating margin is what's really driving their ROE. For the other companies, it's really the opposite. What is bringing all of their ROEs down? And it's all coming from their operating margin and their asset turnover primarily. So just take Chevron for example. Look at their operating margin going from 16 to 3.95, and you got asset turnover going from 0.74 to 0.46. So these are huge declines that affect the ROE a lot. And then Exxon, you got going from 14 to 9 with their operating margin, and then 1.05 to 0.69. And that's just from 14 to 15. If you go back further, you can see that the trend is it's going on for years. It's not just going from right here from 14 to 15, but from 12 and even 2011 for some companies all the way to 15. And that's so you can see what's driving their declines in ROE by using this ROE decomposition. Now, looking at their total debt ratio, what we're going to see is that we can actually kind of separate these firms into the three that is Valero, Chevron, and Exxon, and then we're going to really have to separate Conoco and Marathon because they're going to skew a lot of graphs. And I didn't mean to make them purple and gold for, I guess, LSU, but that's what it wound up being. So the LSU squad's going to be analyzed kind of separately. Nevertheless, you see all of their debt ratios going up since 2012, except for, once again, Valero has going down, but they're actually going back up since 14. And one thing I don't like is a high debt ratio with these oil companies. I think that means they were hurt the most by the oil price collapse and that they're barely hanging on kind of thing. And that means Conoco, Phillips, and Marathon. I really don't like them. And which this is pretty consistent with what I just said. Their EBIT to interest expense interest coverage ratio. You can see Chevron actually didn't have debt for a long time and maybe just got a little bit of debt with their current being 3, but that might not be any kind of long-term debt. It might be something else, but for the most part you could say Chevron doesn't have debt. And then you could look at Marathon and ConocoPhillips and see they're having negative interest coverage ratios, which means they're not able to, they have negative EBITs and then they have high interest expenses. Exxon looks fine with these, with the interest coverage ratio. So one thing that's interesting about the liquidity is, unlike the semis, the companies that I like seem to be less liquid than the ones I don't like. So I like Chevron and Exxon, but their liquidity ratios as of currently are not as good as you would think compared to the other companies. But like Dr. Dougal has told us, these liquidity ratios can sometimes be misleading in that you don't really, a current ratio may indeed mean you're more liquid and can have better chances of meeting your current obligations, but sometimes that means you're being mismanaged in that these companies that have the higher ratios may be less efficient with their management of net working capital. And it's not that they're just that they're doing better and they're a better company so they have higher ratios, but it may be that they are just not being as efficient with their current assets. So that's one thing to think about when looking at their liquidity ratios. But as you can see, Chevron and Exxon are lower than the other companies. So what kind of multiples are they trading at? Chevron is trading at a huge multiple of 112, and Exxon's also trading at 41. The thing about the other companies is that they didn't have data for up until now. Valero's trading at 12, so people are paying more for Chevron and Exxon's growth prospects. So look at their enterprise multiples. Same kind of thing as PE, but a little different. Marathon is actually trading at a high multiple, and then Conoco is trading at an even higher multiple. So it's kind of the opposite in our results, but the ratios are supposed to be pretty similar. But the thing is that they're having these higher ratios because of the debt they're issuing. So we saw they had the lowest PEs, but they had the highest total debt ratios. So debt is going to be increasing their enterprise value, and these companies don't have a lot of cash, so that's why they're having such a high enterprise value. And then their earnings before interest, taxes, and debt depreciation and amortization is very low. So that's why these high enterprise multiples aren't good to me. I'd really rather them be a little bit lower, and I like Chevron and Exxon, particularly Exxon with this. And this is just a graph. As you can see, we have to separate them. You got Conoco and Marathon. Conoco is all the way up to 250%, and 250 multiple. But the trend for all of the companies is that they're going up, and it's really a decline in earnings that this is stemming from, and then that increases in debt across the industry is what's making these multiples shoot up. So to look at the EVA spread, they're all pretty bad. You got Chevron and Exxon at negative. Valero is the only one with a positive, so they're the winner in this category. But what's even worse is ConocoPhillips and Marathon at negative 16 and negative 15. This means these companies really have nowhere to invest their money right now that will be profitable. And that makes sense. I mean, we've had an oil price collapse. It's rebounding a little bit, but overall, we can see that they're really not able to add any economic value as of recently. The supply chain analysis for these companies isn't as important for the semis, or as it was for the semis. Their customers are all either they didn't have data or they had very little significant customers. The one thing that I did take from this is I looked at Marathon's suppliers. They had an 80% of cost of goods sold dependency on Plains All American. So that was pretty interesting to me. And I'm not sure what that company is, but most of their suppliers are the oil field service companies like TechNet and Seadrill. These are pretty much Transocean, Pacific Drilling. These are all oil field service companies. So as far as the analyst recommendations go, you can see Chevron has all buy recommendations. So that's what I really like this company the most. Exxon's a little bit they have some buys, but they also have a good bit of neutrals. And Conoco, they're kind of mixed. But one thing I did like for this is Chevron. Marathon, they're mixed, and Valero is mostly buy readings. So the two companies I like out of this industry is Chevron and Exxon. So the top up here is just a price graph. We've seen Exxon go up 13%, and then Chevron is up 30% on the year. So that's one reason I like them. As for currently though, short-term trading perspective, this is a commodity channel index, which anything up here means that the company would be overbought based on the indicator. I see both companies coming down. Oil's rallied a good bit in the past month or so. So I would maybe wait for these companies to come down. As you can see, a lot of times when they come back down, they fall a good bit. So I would maybe wait after this crosses this 100 threshold again, and I think it will come down a good bit. Same thing with Exxon. They're coming down. And I just think in general, these oil companies may be a little overbought after the OPEC meeting, when they came to an agreement. They rallied, and they may have rallied slightly too much. So that's my project. Thank you.